Picture a scenario where your investments work like a dependable paycheck, arriving right on time each month, smoothing over financial gaps that quarterly dividend schedules often create. Rather than stretching your budget or waiting months for income, there's a way to create a steady flow of funds with a specific kind of investment: monthly dividend ETFs. Imagine receiving income every 30 days from a carefully selected financial vehicle that could provide around 11.5% in annual yield. If you held $1 million position, this would translate to close to $9,600 flowing into your account each month. That amount can shift your financial landscape, especially during retirement when stable income becomes critical. Instead of dealing with the unpredictability of lump sum payouts every few months, this approach offers a way to match your income with your expenses in a more consistent rhythm. The beauty of these ETFs lies not just in the frequency of their payments, but also in their ability to ease the emotional strain that comes with market volatility. You no longer have to constantly monitor stock prices or make decisions about when to sell. The dividends come in, regardless of market conditions. After evaluating the broader ETF market and comparing dozens of funds, a short list of monthly income providers emerges as particularly strong candidates. These aren't just funds offering convenience. They provide a structural solution to managing retirement income. For example, the Wisdom Tree U.S. Quality Dividend Growth Fund, trading under the symbol DGRW, might not grab headlines with its relatively low current yield of 1.6%, but what it offers is long-term potential. It invests in large, financially sound companies such as Microsoft, Apple, Nvidia, and Procter & Gamble, which are well known for consistently raising their dividends. Over time, this compounding growth can result in a significantly higher yield based on your original investment. While it may not deliver the highest monthly payouts today, it offers a strategic option for those planning years ahead, rather than seeking immediate returns. Another strong option is the JP Morgan Equity Premium Income ETF, known by the ticker JEPI. This fund takes a slightly different route by incorporating a covered call strategy. It holds a portfolio of reliable companies like AbbVie, MasterCard, Microsoft, Visa, and Southern Company while simultaneously generating extra income by selling call options. This tactic allows JEPI to deliver a higher yield, around 8.08% annually. It's particularly effective in markets that are moving sideways, offering consistent payouts without needing to liquidate holdings when markets dip. It distributes income regularly and avoids the risk of over-relying on a single sector or stock, creating a layer of resilience that's attractive to income-focused investors. For those wanting a fund that weathers economic storms, the Invesco High Yield Equity Dividend Achievers ETF, listed as PEY, offers a pragmatic choice. This fund concentrates on companies with a strong history of paying and raising dividends, such as Pfizer, Verizon, and Edison International. These firms provide products and services that consumers continue to use even during downturns: electricity, medication, phone service. That makes PEY a defensive asset in turbulent markets while still providing a respectable monthly yield of about 4.8%. It's ideal for those who want current income but also value some buffer against volatility. Meanwhile, the Invesco S&P 500 High Dividend Low Volatility ETF, known by the symbol SPHD, goes even further in protecting against sharp market movements. Its method focuses on picking stocks from the S&P 500 that not only yield above average dividends but also show low historical price swings. This makes it especially suited to retirees who can't afford big portfolio drawdowns. With holdings like Crown Castle, AT&T, Vici Properties, and Realty Income, some of which are real estate investment trusts required to distribute 90% of their taxable earnings, SPHD manages to combine safety and solid income. The yield is approximately 3.42%, which may not be the highest, but the stability it brings to a portfolio can be invaluable. The most aggressive income provider in the group is JP Morgan's Nasdaq Equity Premium Income ETF, referred to as JEPQ. This fund integrates a covered call strategy targeting the technology-heavy Nasdaq index, which includes giants like Nvidia, Microsoft, and Apple. It doesn't just offer tech exposure, it enhances it with income, generating a remarkable yield of around 11.5%. Although this approach may limit upside during explosive bull markets, many retirees find the regular, robust income well worth the trade-off. Holding JEPQ in a $1 million portfolio could result in monthly payments exceeding $9,500, making it one of the most potent income solutions available. In terms of portfolio construction, different approaches yield different results depending on personal financial goals. One could divide a $1 million portfolio evenly among all 5 ETFs, gaining exposure to growth, yield, and defensive positioning simultaneously. This would result in a blended yield of about 5.88%, translating to roughly $4,900 each month. Alternatively, if maximizing immediate income is the primary objective, the portfolio could lean more heavily toward JEPQ and JEPI, allocating about 60% to the former and 30% to the latter, with the remaining 10% split between SPHD and PEY. This mix could deliver monthly payouts around $8,100, satisfying most monthly budget needs without compromising liquidity. There's also a hybrid strategy for those who want a mix of income today and growth for tomorrow. A possible allocation might include 40% in JEPQ, 25% in JEPI, 15% in SPHD, 10% in PEY, and 10% in DGRW. This combination seeks to balance current yield with dividend growth potential over time, generating approximately $6,400 per month. This structure suits someone entering retirement with a multi-decade horizon, aiming to maintain purchasing power as inflation progresses. One of the most overlooked advantages of these monthly paying ETFs is psychological. Knowing that income is arriving regularly without needing to sell during market downturns can help investors avoid making emotionally driven decisions that undermine long-term success. The need to watch stock charts and panic over every red candle diminishes. The ability to stay the course, even when markets are choppy, is greatly enhanced when cash flow is secured through dependable dividend income. Ultimately, building a portfolio with these ETFs isn't just about maximizing numbers. It's about aligning income with expenses, protecting capital, and ensuring a calm, confident financial future. JEPQ may stand out as the top choice for those in need of immediate income, but that doesn't make it the only tool worth using. Your timeline, income demands, and comfort with risk should all guide your allocation decisions. As always, it's wise to do your own research or work with a qualified financial professional before taking any action. Investing is about long-term outcomes, and these monthly dividend ETFs are some of the most effective tools available today to create consistent, reliable income that can support a fulfilling retirement.